All right, guys, let's start. Okay. So today we are doing the 22nd chapter of operational risk, which is your solvency, liquidity, and other regulations after the global financial crisis, right? So global financial crisis was a big event, especially if you think in terms of risk management, and a lot of regulations changed after the global financial crisis. We have seen the you know how global financial crisis have evolved, or how regulations after the global financial crisis have evolved. 1988 we had Basel 1, then we had 1995 Basel 1 amendment, 1996 Basel second amendment of Basel 1, then Basel 2 came up, and then global financial crisis happened. And then since the global financial crisis happened, a lot of things changed in the world of risk management, right? So the focus of this chapter is that we will understand what exactly changed after the global financial crisis, why it changed, how the changes which happened compared, or what is the comparison of those with the Basel 2, right? The previous version, right? So keep in mind that till now we have studied your Basel 2, its amendments, and Basel 1 also. All of these were pre crisis regulations. The GFC, the global financial crisis, exposed the weaknesses in those frameworks. This chapter is about the post crisis reforms, basically Basel 2.5, Basel 3, and other regulatory tools that came because the old system kind of failed. Okay, the chapter is split into your three modules, right? First module is about your stress war, incremental risk capital charge, basically, and the comprehensive risk charge. Basically, this is all about your Basel 2.5, and these were your market risk fixes, right? So it was immediate action just after the global financial crisis, that you wanted to fix the market risk factors. Then we came to the Basel 3, right? Basel 3 requirements, capital requirements, buffer and liquidity rules. This is the big overhaul which happened after Basel 2 failed. And then we'll talk about your COCOs, contingent convertible bonds, and your Dodd-Frank reform. Okay. So the idea here is that before crisis, there were lighter rules, there were bank self models, weak liquidity. After crisis, the rules became stronger, stronger capital, stronger liquidity, more supervision, etc. Okay, so let's get started. Let's go deeper and understand it more. A lot of theory, guys. I don't have to write much here because it is very, very theoretical in nature. So keep listening. I'll highlight key points. I think that is very, very important here. Fine. Perfect. Okay. So now we are focusing on your module 1. Okay. So module 1, the topics which are covered are basically introduction, what changed after your global financial crisis. Then we'll talk about your stressed war overview. We'll talk about calculation, right? That is very important. Stressed war calculation that we'll try to understand, and then we'll go into what is incremental risk charge IRC, and then finally we'll talk about the comprehensive risk coverage, right? So Basel 2 underestimated kind of market risk because the war was calculated using your calm period. Basel 2.5 fix that by enforcing your models to include your stress periods and adding your new charges, your incremental risk charge, and your comprehensive risk charge. Okay, so that's what we have here. Fine. Let me explain you these things in detail. A lot of theory, guys. See, operational risk is all theoretical in nature, so keep listening, you'll understand. Okay. So the first bullet point here is post-crisis capital reform. So before the crisis, please understand Basel II allowed banks to use your internal models, right? Probability of default, loss given default, exposure default. These, there was Basel 2 was allowing you to use your internal models, so it kind of underestimated your risk. And after crisis, regulators tightened everything, Basel 2.5 and Basel 3 in both of these reforms. Aim was to have more capital, better quality capital, and your buffer for your stress, right? So that was the first point. And second point, we need to understand that there was some key capital regulation changes, your incremental risk charge, your comprehensive risk charge, your stress war, your capital conservation buffer, your countercyclical buffer. So Basel 2 kind of missed your tail risk. Basel 2.5 introduced stress war, IRC, CRM, and Basel 3 added buffers to ensure banks don't fall below your minimum capital in bad times. Then we have liquidity risk management, right? Before crisis, Basel 1 and 2 had zero liquidity rules. After crisis, Basel 3 introduced your LCR, liquidity coverage ratio, and net stable funding ratio, the first global liquidity framework. Okay. Then we have alternative funding sources where higher capital requirement, banks need safer funding, hence new instruments such as your COCOs, which are your contingent convertible bonds, right? Which help banks raise your loss absorbing capital. Then there was a capital ratio calculation, new measurable metrics, leverage ratio, which was non risk based, LCR, liquidity coverage ratio, your NSFR, net stable funding ratio, all were calculated and still calculated using your balance sheet data. Then there were some institutional reforms. Institutional reform means new US bodies were created, like your FSOC. FSOC is Financial Stability Oversight Council, your CFPB, Consumer Financial Protection Bureau. Aim was to improve your supervision and consumer protection. So that is why it was done. Next one is comprehensive regulatory framework. After the crisis, regulation moved from being narrow, capital only, to being your comprehensive, covering your capital, covering your liquidity, covering your stress periods, buffers, and systematic risk supervisions, right? So that's what was done. Okay, so this is done. Very theoretical, very easy. Just have in mind the comparison which I'm saying. Okay. Now let's go to stressed war, right? The overview for the stress war. Now, basically, you should understand here that we are now clearly stating that Basel II kind of underestimated your risk, and there was a crisis situation. Thereafter, Basel 2.5 came. So Basel II coincided with the crisis, or Basel II kind of failed because it relied heavily on the bank's internal models, right? Your advanced IRB approach allowed banks to use their own estimate of your PD, your loss given default, and exposure at default, right? So these were allowed. And banks modeled risk based on your good times, giving artificially low war, okay, which was problematic, right? So students must understand that Basel II was kind of pro-cyclical and underestimated your risk. Advanced IRB approach allowed banks to plug in their own PD, LGD, EAD. And this was good in theory, right? Nothing wrong in theory, but very, very dangerous in practice uh, when banks choose your optimistic scenarios, right? Then the Basel 2.5 response came. Regulators realized that war based only on your calm period is useless. Banks must include your stress periods. And so Basel 2.5 introduced three fixes. What were the three fixes? That first of all, three primary changes. The calculation of your stress war must be calculated using a crisis like period, example 2008 market data. This ensures your capital reflects your bad time, not just your good times. Incremental risk charge, which covers your default and migration risk in trading books. Basel II kind of ignored this. Objective was to better capture your credit related losses in bonds and credit products. And then your comprehensive risk charge for complex securitized products, CDOs, etc. Objective was to capture a correlation and tail risk that war completely missed in the pre-crisis period, right? So overall, please understand that you should think of Basel 2.5 as not a full overhaul, but as a patch, as a temporary fix to your Basel 2. Basel 2 kind of underestimated risk. Crisis exposed the flaws. Basel 2.5 added your stress war, your IRC, your CRM to force banks to hold more realistic capital. And Basel 3 comes after Basel 2.5 and is even bigger, right? Adding your liquidity ratios and capital buffers. Okay. So this is it, right. Let's move ahead. Next one is the stressed war calculation. Okay. When I talk about stressed war calculation, please understand why stressed war was needed. If you compare before versus after, please understand that before the crisis in the Basel II period, banks calculated your historical simulation or your war using your historical simulation from the past 1 to 4 years. 2003 to 2006 was a relatively low volatility period. War was very low. Even when the crisis started in 2007 8, the war numbers were still based on the old calm data. and so capital stayed unrealistically low, right? So that was one of the reason. And after the crisis, Basel 2.5 regulators forced banks, right? They addressed this problem and forced banks to include your bad times data. They clearly articulated that stressed war should be introduced using a 250-day stress period, right? And what is important to understand is that normal war tells you the risk in your good times, right? Stressed war tells you the risk in a bad time, right? In a storm, right? Now the next question comes is that how do you choose the stress period? Initially, regulator wanted that 2008 to be the stress period for all banks. Now things have actually changed. Each bank must choose its own worst 1 year period in the last 7 years. Why? Because one bank may be heavy in credit, another may be heavy in equities, so their stress year is very different, right? Now when you look at your Basel 2.5, right? Basel 2.5 require you to calculate your two wars. Banks must compute your regular war. Banks must compute your stressed war, and these are combined, and that's why we get this formula. In this formula, you can see we have normal war, we have stress war, right? Normal war, we have max war for t minus 1, which is yesterday, comma m into war average, plus max of stress war, comma m into s war average. Please understand that the war average is the average war over your past 60 days, and here the horizon is 10-day horizon at 9% confidence level. S war t minus 1 is a previous day test war, again 10-day horizon 99%. Your confidence, everything is 10-day horizon 99% confidence, right? When you take it, and then multiplicative factor is different. This is multiplication factor, so is supervisor determined minimum 3. Here it is also supervisor determined minimum 3, right? So please understand that this formula makes sure risk is not understated during your calm markets, because stress data is always included in the capital calculation. Now, what is the impact of such thing? Please understand that capital charge under your Basel 2.5 is at least, right, twice your Basel 2, right? So due to the addition of your stress war. So Basel 2 had only your war. Basel 2.5 adds your stress war and capital almost doubles. Okay, so please understand this very, very carefully. A lot of theory, but please try to understand. Moving on, guys. Next is a practice question, right? What is the practice question here? Please understand which of the following statements about a stress war required under Basel 2.5 is correct. Okay, let's read the statements. First statement is Basel 2.5 had established the year 2008 as the stress period. All banks use data from 2008 to calculate the stress war. Now, see, 2008 was told earlier, but now it is not mandatory, right? So this goes away. Okay, so Basel 2.5 clearly says that 2008 is not mandatory. Then, if you look at the second option, the stress war replaces the normal war for the purpose of calculating capital for credit risk. Stress war does not replace normal war, right? It is in addition to normal war. So this also goes away. Next one is your market risk capital under your Basel 2.5 should be at least double that of market risk capital under Basel 2 due to addition of stress war. Makes sense. This is what I told you. So C looks likely the answer. Let's read D option also. The stress war must be calculated using a 99.9% confidence interval. No, it is 99%, not 99.9%, right? So answer is C. Okay. That is what has been explained here also. Basel 2.5 required banks to calculate two wars, the usual war using the historical simulation method and the stress war using a 99% confidence level, 250-day period of stress market condition, same thing which I told you. The total market risk capital charge is the sum of usual bank war and the stress war. Initially, regulators thought the year 2008 would be ideal for stress condition. However, banks are now required to identify a 1 year period when their portfolios perform poorly, right? So 2008 is not mandatory. This means the stress period may be different across banks. Okay. So we have understood everything and we have discussed everything in the theory also. Fine. Now we are going into your incremental risk charge. When I talk about incremental risk charge, please understand pre-crisis in the Basel II trading book capital was your much lower than your banking book capital. Why? Because when we consider your trading book used, you know, 10-day 99% war, it was very small capital. Okay. And banking book which used, let's say, uh, 1 year, right? So trading book used 10-day 99% war, banking book used your what? Banking book used 1 year. Trading book used 99, 10-day 99% war. Banking book required 1 year 99% confidence level war. Now, see, the point which we need to understand is that trading book used 10-day war, right? So, which is a very small capital. Banking book used 1 year war, which is a much bigger capital, right? So, banks moved your risky credit products into the trading book to get your lower capital, which was a regulatory arbitrage, and this was a big flow or big flaw in your Basel II because banks used to move assets from one category to another. Now, what did Basel Committee do here? Basel Committee response was that they introduced your IDRC, incremental default risk charge, in your 2005, requiring 99.9 confidence level, 1 year war for trading book measurement sensitive to default risk, right? So see how things have changed. IRC requires 1 year horizon, 99.9% confidence covers your default plus rating migration, applies to your credit sensitive instruments in the trading book. Okay. So IRC brings your trading book capital up to the same level as your banking book capital, right? So that was happening. Fine. Now, why this thing evolved into, let's say, IRC, right? IDRC was revised to IRC, right? Because during the 2007-9 crisis, losses came not only from your actual defaults, but from your downgrades, but from your credit spread widening, liquidity drying up. So war kind of ignored these. IRC captured them. So that's why, after seeing the data, further change was there for all rate sensitive instruments and requiring banks to consider rating change sensitivity and expected portfolio rebalancing to reduce your default risk. Okay, fine. Next one is that we try to understand, right? After studying this part, right? We try to understand the liquidity horizon, okay? Because that is also very important because see, liquidity horizon is a very important concept whenever we are discussing your liquidity risk, right? Liquidity risk was very important part in your financial crisis. So now we are discussing your liquidity horizon. Banks must estimate how long it takes to sell each instrument. Minimum horizon is at 3 months. There is a rebalancing assumption. Rebalancing assumption means at the end of each liquidity horizon, the bank is assumed to sell your downgraded, defaulted instruments, replace them with instruments of original rating. Example, a AA bond was downgraded, sell it after 6 months, buy a new AA bond, right? Why do we do this? Because this creates small losses. You sell at your lower price, but reduces the chances of large default loss. This keeps the risk level constant. Then once you look at a specific risk charge, right? IRC captures the downgrade and the default risk. SRC capture the spread changes, changing credit spread, not covered by IRC. And what we need to understand is that rebalancing creates small losses, which I told you, but reduces your default likelihood, generally lowering your 1 year 99% war calculation. And we have to do rebalancing at every 3 months, 6 months, or other interval based on your estimated liquidity horizon. Fine. Okay, let's move ahead, guys. Let's do a practice question now. Banks are required to rebalance their portfolios as the creditworthiness of bonds decline, leading to losses over time, but generally not to outright default. This requirement to specify a liquidity horizon for each instrument in the portfolio and rebalance at the end of the liquidity horizon is part of what? See, this is part of what? This is part of your incremental discharge calculation, right? There's not we have actually we haven't studied this net stable funding charge till now, so this goes away. Countercyclical buffer we have not studied, this goes away. Comprehensive risk charge we haven't studied till now, this goes away. We just studied that we are looking for liquidity horizon, we are looking for rebalancing, we are looking for downgrade losses. These are exact component of IRC. Other option, which is your net stable funding charge, NSFR, buffers, CRM, do not involve liquidity horizon on your rebalancing. Okay, so keep that thing in mind very, very clearly. Okay, so this is what has been given here as well in the solution as part of the IRC calculation. Banks are required to estimate a liquidity horizon for each instrument in the portfolio. For example, double rated bond in the portfolio has a liquidity horizon of 3 months. If at the end of 3 months the bond has defaulted or has been downgraded, it is assumed that the bank will replace the bond with another double rated bond comparable to the one held at the start of the period. This rebalancing is assumed at the end of each 3 month period or 6 month, 9 month, etc., depending on the estimated liquidity horizon. Rebalancing allows bank to take losses. The instruments are downgraded, but generally allows the banks to avoid their default. Okay, keep that in mind very, very clearly. Right. Overall, please understand very, very categorically before I move ahead to comprehensive risk charges that Basel II underestimated your risk because war was based on your calm data, short horizons. Basel 2.5 fixed this by adding your big changes such as your stress war, which uses your bad time data. Incremental risk charge adds 1 year, 99.9% credit and downgrade risk. Together, they corrected the weakness that caused the crisis. Okay, fine. Now we are going into your comprehensive risk charge, another topic, right? Another small topic in the same discussion. Okay. So when you think about comprehensive risk charge, what you need to understand, students, is that CRC is a single capital charge, right? CRC is a single capital charge for complex credit products that depend heavily on the correlation risk. Okay. Objective was that you are trying to replace the specific risk charge which you just discussed and the IRC for this component, right? So please understand what we are doing is we are replacing the SRC, specific risk charge, plus your IRC for these instruments. Which instrument? Instruments which depend heavily on your correlation risk. Now Basel 2.5 simplified and strengthened your capital for the most complex product. And when you look at instruments covered, especially the correlation book, what were the instruments covered? It applies to product whose value depend on how different assets default together, such as your asset-backed securities, your collateralized debt obligation. These products blew up in 2007 to 8 and 9 because defaults became kind of correlated. So the learning or the experience from the crisis was that in normal times, senior tranches, right, highly rated tranches like your AAA, your AA, looked very safe. But during crisis, correlation kind of shot up. Even your highly rated tranches suffered. So Basel II assumed your diversification. Basel 2.5 learned that in crisis, diversification disappears. And then we have a table for standardized approach for rated instruments. There are two categories here: securitization, resecuritization, securitization. We understand these are normal securitized products like MBS, ABS, CDOs, etc. Resecuritization, the products are like CDO squared, right? You have studied in FRM part 1, CDO squared. CDO squared. So these were very, very complex products. These are called resecuritization, very risky. Pattern here is very simple. If you have higher rating, right, you see AAA to AA minus, lower capital requirement. If you have low rating, BB and below, very high capital required. You can see here it is 100% also, and here also 28%, 52%. Unrated or below, BB 100% capital must hold dollar for dollar. Resecuritization gets much harsher treatment. You can see 3.28. The percentages are much higher than the securitization because they are kind of correlation time bombs, right? Because the correlation is very high there. And when you look at your unrated and your low rated instruments for below BB minus, bank must hold 100% capital, meaning there is a requirement to hold your full exposure amount as capital. Effectively, you discourage these kind of holding. This is Basel way of saying that it is too complex or too risky to rate, so don't hold it. Just try to avoid it, right? And then if you want to hold it, be ready to put 100% of capital against these. Then once we have seen this, right? Once we have seen this, let's go ahead. Okay. So next part we need to understand is we're still continuing with the comprehensive risk charge. So that's why I told you, right? You have to hold 100% capital. Next point we need to understand is that in internal model approach, which is optional, right? We have studied till now that internal model approach is not mandatory; it's optional. If a bank is ready to do it, right, they have to meet some strict criteria. Optional, but the rules are stricter. Okay, in your internal models, if a bank wants to use your internal models for your comprehensive risk charge, the model must capture your credit spread risk, your multiple defaults, your correlations, volatility, your link between correlation and credit spreads, your cost of rebalancing hedges, your recovery rate volatility. To use internal models, banks must prove their model can handle all the things that fail during the crisis. Okay, so that is the requirement. Please remember this, guy. This is very important. Fine. So we are done with this. Now we are trying to cover module 2. Okay, the first part is done. Now we'll try to understand the module 2, the second part of the lecture, which is understanding we are developing after Basel 2.5, what happened, right? The next big overhaul after Basel 2.5 was your Basel 3, right? Basel 3 happened after Basel 2.5. And what exactly happened in this big overhaul? In your Basel 3 capital requirement, the purpose of Basel 3, right? The purpose of Basel 3 was that you want to understand the failures of Basel 2, and then you need to understand that what was the capital requirement. So we are divided this module into three parts: Basel 3 capital requirement, the capital conservation buffer, and countercyclical buffer. Last is liquidity risk management, right? Which is NSFR and your LCR, okay, and some ratios. Fine. Now let's try to go into your next part, right? We'll try to understand in depth what exactly changed in your Basel 2, and what was the purpose, and what exactly were the weaknesses, etc., which were revealed, right? So let's try to understand your Basel 3 capital requirement, right? So what was the purpose of Basel 3, right? We try to understand. See, Basel 3 try to answer the failures of your Basel 2. The requirement was that we understood that there's more capital required against your credit risk. There was a requirement to have your tighter definition of capital. We have to remove the tier 3 capital, and it was rolled out after 2010-11 and later amended. Okay, so Basel 2.5 fixed your trading book problems. Basel 3 fixed everything else like your capital quality, your liquidity buffers, your leverage ratio. So we have to understand that. So what were the weaknesses which were identified in the crisis? So the crisis revealed some weaknesses which we need to understand. So weaknesses revealed was that tier 1 common equity became the only meaningful capital during crisis. It was seen that market trusted only common equity. Everything else like your hybrid capital, your tier 2 equity, or tier 2 capital, your tier 3 proved unreliable. There was systemic risk. There was a classification of SIFI, systematically important financial institution. Regulators saw that some banks are too interconnected to fail. So result was the SIFI categories and extra capital was the requirement. Banks manipulated RWA. Basel 2 was purely risk weighted. So there was manipulation. Banks gamed the models. So Basel 2 or Basel 3, in fact, added the leverage ratio as a backstop, right? So that was added. Then banks needed much more capital than your minimums. Even technically solvent banks needed capital infusion, indicating that old rules were very weak, to be fair. So we had to understand that. And there were your liquidity issues, right? What is liquidity problem? Solvent banks still failed because they ran out of cash. Basel III added your LCR and NSFR, right? New liquidity requirements were added. There were derivative counterparty failures. Lehman failure taught that banks could fail due to derivative exposure. Basel III added your CVA, right? Your trade value adjustment, capital charge, which will come later in your FRM, right? So we'll not talk about it much, but what I'm trying to tell you is that the failure of Lehman uh, kind of changed the game, right? Banks had to revalue, right, their derivative exposure using your CVA capital charge, and there was large exposures. It was understood that banks, the Basel III limited your single counterparty exposure to avoid your one client killing a bank. So that was a requirement, right? So establish global standard limiting single counterparty concentration 15% of capital for global CPs and 25% for other institutions, right? So that was the requirement. Fine. Next one is we need to develop the understanding of tier 1 capital. When I say tier 1 capital, please understand what exactly tier 1 consists of. Tier 1 includes your core capital. When I say core capital, it is common equity plus retained earnings, some unrealized gains or losses, and your minority interest, right? So that we need to understand. What tier 1 exclude, does not include, is your goodwill. There is no goodwill here. There is no other intangibles here. No deferred tax assets here. No DVA debit value adjustment here. No artificially retained earnings from securitization. So tier 1 must be pure loss absorbing capital. Additional tier 1, AT1, right? That includes your non cumulative perpetual preferred stock, loss absorbing capital, which is COCO like, uh, contingent convertible bonds, minority interest with certain conditions. This is a going concern capital, right? Please understand. But since it's a going concern capital, but it has your lesser in quality than your common equity. Okay, so that we need to understand. Please understand this definition, guys. Next one is we need to figure out what is tier 2 capital, right? Tier 2 capital, you need to understand that if tier 1 was going concern that absorb your losses while bank is still alive, tier 2 was gone concern capital, absorb your losses when the bank is failing. What tier 2 included was that there was a subordinated debt, which is anything which is greater than 5-year maturity, that was in tier 2, right? Some preferred stock, right? General loss reserve limited to 1.25% of standardized RWAs or 6% of your internal rating based RWAs. There was some downward adjustment, capital adjusted downwards to reflect your debts subordinated to depositors with an original maturity of 5 years or more. Some preferred stocks, such as your cumulative perpetual preferred, and some general loss reserves not allocated to absorb losses on specific position. Again, limit was there 1.25% of standardized risk weighted asset or 0.6% of your internal rating based RWAs. Okay. The key concept here is that depositor rank above tier 2. So tier 2 is a gone concern, first of all. Secondly, tier 2 only absorb losses if the bank fails. So that is one part we need to understand. That is why tier 2 is not considered high quality capital. When a bank has negative capital, is no longer a going concern. Tier 2 capital absorb losses. Depositors are ranked above tier 2 capital. So in liquidation, so theoretically, as long as tier 2 capital is positive, depositor should be paid in full, right? And common equity is going concern. It absorbs losses when the bank has positive equity. Okay, that we need to understand. Fine. Going ahead, guys. Under your Basel 3 question here, under your Basel 3, capital must be adjusted downward to reflect which of the following, right? Planned bonuses for managers? No, there's nothing like that. Deficit in defined benefit pension plan. Now, this is very tricky. See, Basel 3 require capital to be reduced for defined benefit pension plans deficits. So let me write it down. This is a little tricky. Basel 3 requires capital to be reduced for defined benefit plan deficits, certain cross holdings, right? Mortgage servicing rights. Okay, remember this. Little tricky. It is part of downward adjustment. It is not given here, to be fair, but this is a tricky question, so I have highlighted there. So please note down. It's a downward adjustment, so keep that in mind. Fine. Very tricky. Remember that. Why not others? Let's discuss that as well. Why not others? See, when we think about others, please keep in mind that bonuses do not reduce your capital, so that's why it goes away. Convertible debt, right, is not reduced, that goes away. There is no requirement for Basel 3 to adjust capital downward for anything. No, that is wrong. We have to adjust, right? Tricky question. Answer is B. I have written down the logic. Basel 3 requires capital to be reduced for defined benefit plan benefit deficits, certain cross holding, and mortgage servicing right greater than 10%. Okay, fine. So this is what has been given here. Very tricky question. Now I'm making a star mark. You have to remember this. Okay. Overall, what you need to understand once you kind of understand your total, uh, your tier one capital, additional tier one capital, tier two capital is uh, you had Basel 2, you had crisis, you had Basel 2.5, then you had Basel 3. Basel 2.5 fixed your market risk underestimation, you had stress war, your IRC, your capital risk charge. Basel 3 fixed the rest, capital volatility buffers, liquidity, leverage, CFI rules, etc. Right? So we are discussing that now. Don't lose the bigger picture, zoom out and uh, keep that in mind. Okay. Next one we try to understand is the total capital requirement under your Basel 3, right? So now what Basel 3 changed compared to Basel 1 and 2? Basel 3 did not change the 8% rule which we had, right? So it did not change the 8% total capital rule, but it changed what count as capital and increased your tier 1 requirement. Basel 3 minimums are 4.5 tier 1 equity capital, which is required, then 6% total tier 1 capital, right? Equity capital plus your additional tier 1 capital, such as your perpetual preferred stock. Then your total capital, which is total tier 1 capital plus your tier 2 capital, must be at least 8% of RWS at all time. That was also unchanged, right? This was left unchanged. So if you compare with the pre-crisis rule, just for your knowledge, Basel 1, under Basel 1, where tier 1 requirement was 2% of RWS, right? And total tier 1 requirement was 4% of RWS, right? So that changed. So Basel 3 almost double those rules. The new requirement was significantly more rigorous because percentage was higher, definition of what qualities are equity capital has been tightened, and the 8% total capital requirement is the same under your Basel 1 and Basel 2, but the stricter definition of equity capital applies under your Basel 3, right? Definition had become stricter, and Basel 3 basically increased your quantity and your quality of capital. Fine? Perfect. Moving on, next is your capital conservation buffer, your CCB. We talk about capital conservation buffer, very important to understand why CCB was created. CCB protects your banks in bad times, similar to the US prompt corrective action system, which is your PCA, right? Banks must build extra capital in good times so they can use it in bad times. Size of CCB was kept as 2.5% of RWA in normal times. So if normal time requirement of tier 1 equity was 4.5%, that was the base, you added 2.5% CCB, it becomes 7%. If tier 1 capital was 6% base, you add 2.5%, become 8.5%. If total capital was 8% base, you add 2.5%, become 10.5%. Right? So in normal times, total capital is effectively 10.5%, not 8%. And there are certain dividend restrictions. If a bank kind of dips into the buffer, it cannot pay full dividend, it must retain your earnings, which is 60% retention if tier 1 equity capital is 6%. Okay, this forces banks to rebuild your capital. All right, next one is GSIB. Fine, GSIB CCB requirement. GSIB is what? Global systematic important banks. Global systematically important bank, GSIB, right? Now, what is the motivation here? You want to avoid taxpayer-funded bailout of giant banks such as your HSBC, JP Morgan, etc. These are giant banks. GSIB has a surcharge. There's the extra capital from 1% to 3.5% above CCB for GSIB, right? HSBC and JP Morgan are put in 2.5% category. There is a leverage ratio buffer. GSIB must hold leverage buffer, which is half of the risk-based GSIB buffer, or half the sum of CCB plus GSIB risk buffer. And then there's a total loss absorbing capacity. GSIB must hold instruments that can absorb your losses, like your equity, subordinate debt, COCOs, debt that converts into equity. If a GSIB fails, total loss absorbing capacity get wiped out or converted before the taxpayers are kind of untouched, right? Or sorry, taxpayers are touched, right? So ultimate objective is you want to leave your taxpayer untouched, right? So keep that in mind. Very simple. GSIBs are important bank. Like India has GSIB called. For India, I cannot be a GSIB because it's a global systematic important bank. For India, it is like a CFE, right? For India, CFE is your HDFC, ICI, SBI. Let's do the practice question. The capital conservation buffer, CCB, right? Which is the statement which is right. So CCB is intended to protect banks from the counter-cyclical nature of bank earning. No, it's not counter-cyclical nature, right? CCB can be between 0 to 2.5% of risk-weighted asset and is at the discretion of the regulator in individual countries. No, that's not the case. CCB is always 2.5, not variable, right? So this goes away. Then CCB caused a tier 1 equity capital ratio requirement increase to 7% of risk-weighted asset in normal economic period. Yes, 4.5% plus 2.5% makes it 7%, right? So very, very important. Looks like C is the answer. Requires that total capital to risk-weighted asset must be 10.5% all time. No, that's not 10.5% all time. CCB does not require total capital to be 10.5% at all time. Only in normal times, it is 10.5%. Okay, keep that in mind. Tricky, right? So CCB is mandatory. 2.5% tier 1 equity buffer that increases tier 1 equity requirements to 7% in normal conditions. Keep that in mind very, very clearly. Okay. Overall, please understand before crisis, Basel 1 and 2, tier 1 equity was 2%, total capital was 8%, there was no buffers, there was weak capital definition, the banks entered your crisis undercapitalized. After crisis, tier 1 equity became 4.5%, which was base. Total tier 1 became 6%. Additional CCB was you added CCB, which was 2.5%. You added GC buffer, which was 1 to 3.5%. You added leverage ratio. You added liquidity rules. So large banks now hold between 10 to 5%, 10.5% to 14% total capital rather than 8%, right? So you have added more and more now. Fine. So that is what is the requirement, right? That is what I'm trying to say. The CCB is meant to protect banks in times of financial distress. Banks are required to build a buffer to tier 1 equity capital 2.5% of risk-weighted asset in normal times, which will then use to cover a losses in stress period. This means that in normal times, banks should have a minimum of 7% tier 1 equity capital to risk-weighted asset and 8.5% total tier 1 capital to risk-weighted ratio and 10.5% tier 1 plus tier 2 capital to risk-weighted. But this is normal time. The CCB, the requirement is not left at the discretion of the individual country regulation. All right, it is not a requirement of at all time, but it's built up to that level in normal economic periods and declines in your stress period. So keep in mind, declines in your stress period. Okay, fine. Next one is your counter cyclical buffer, right? Very interesting, counter cyclical buffer. When you talk about counter cyclical buffer, please understand this buffer is added on top of your CCB when the economy is overheating, right? Economy is overheating, then you add it on top of your your CCB, right? What is the motivation? Why we need CCYB, which is counter cyclical buffer? Please understand, bank credit grows credit grows too fast in good times and crashes in your bad time. CCYB forces banks to build your extra capital during your boom so they can absorb losses during your bust. So it kind of smoothens the credit cycle. The requirement is 0 to 2.5% of RWAs. Discretion of each country's regulator. This is where we need to understand. Very, very interesting. And must be met with your tier 1 equity. Key differences from your CCB is CCB is fixed, CCYB varies by country and by cycle. Okay, so international banks face complexity as CCYB requirement vary by country, with their overall requirement calculated as a weighted average of CCB rate across all nations when they operate. Okay, then obviously there is complexity. International banks, a global bank must meet a weighted average CCYB across the countries where it operates. The rationale is overheating, which I told you. Higher capital restricts your trade growth, which cools the economy. Cost of capital, banks should raise capital when it is cheap, not when crisis hit. So CCB is a fixed buffer. CCYB is a variable buffer that rises in booms. Okay, so that is what is the requirement. You have to remember it, guys. Next one is your liquidity risk management. Okay. So what was the lesson in the crisis again? The crisis lesson was that we have seen Northern Rock. Northern Rock showed that solvent banks can fail purely from liquidity shortages. Basel 2 had no liquidity rules. Basel 3 corrected this, right? Basel 3 aimed to improve your liquidity risk management. There was a minimum leverage ratio, which was a backstop. For minimum was 3%. Formula was capital divided by total exposure. Important thing is to understand exposure is not risk weighted, includes on balance sheet item also, plus certain off balance sheet item also. The purpose is that you stop banks from taking huge exposure while reporting your small RWAs. There was a mismatch financing issue. What is a mismatch financing issue? Banks borrow short term, which is your commercial paper, repos, fund your long term loans. If short term funding freezes, bank kind of collapse. So Basel 3 introduced your two key liquidity ratio, which is liquidity coverage ratio LCR and NSFR. LCR is 30-day liquidity survival. NSFR is 1 year stable funding. So that we need to understand now, right? So our focus shift here. Please understand that, see, LCR and NSFR is discussed a lot in your liquidity risk book, which is a different book altogether. Here we will understand these, but we'll only touch the introductory part, not go too deep. But they are coming in depth in the different book. Okay. Now, when you talk about your liquidity coverage ratio, what is the focus here? Banks must survive a 30-day market stress without external help. There are stress scenarios. Stress scenario includes your three uh, notch downgrade, right? Three notch downgrade is one stress scenario. Loss of deposit is another stress scenario. Loss of wholesale funding is another stress scenario. Higher collateral haircut is another stress scenario. And drawdowns of credit line is another stress scenario. So formula here is when we try to calculate LCR here is your HQLA, high quality liquid asset, HQLA, high quality liquid asset. Okay. HQLA divided by what? Net cash outflows, and that ratio should be greater than 100. That ratio should be greater than 100%. Right? What is the meaning of this? Meaning is the bank must hold enough top quality liquid assets to survive a 30-day liquidity crisis. Okay. What do you mean by HQLA? High quality liquid asset. Please understand, when you talk about high quality liquid asset, you have central bank cash, your government bonds, which is 0% risk weight. You have haircuts. Okay. Uh, Haircut means corporate bonds and equities that get 50% haircut. If you have 100 million, count it as your 50 million HQLA, right? Then you have implementation complexity because different deposit types have different withdrawal speed. Retail insured deposit have 3% outflow. Wholesale funding, you have 100% outflow, right? So that is again problematic. You will learn all this in your liquidity risk, which is very tricky. LCR is short-term liquidity safety belt, which we calculate. Okay, don't go too deep here, but yes, try to understand the definition and at least why are we doing it. Okay, introductory part. Then we have net stable funding ratio. When I say net stable funding ratio, please understand, and the LCR which you studied just now, that was fixing your 30-day survival. NSFR, net stable funding ratio, fixes your 1 year stability, right? The focus here is the bank's ability to operate normally for 1 year with stable funding. Okay, formula here is NSFR is your amount of available stable funding. ASF, available stable funding, ASF. Okay, divided by your required stable funding, right? It should be greater than 100%. Now, ASF is very tricky, right? Available stable funding. ASF, when you look at ASF, please understand higher ASF means that funding that is sticker, right? Sticker and more stable, right? Means higher factor means more illiquid, less likely to leave the bank, similar to your haircuts, right? So we are looking at sticker funding. Okay. Now examples which are given here, in the table, right, which is given in your book also. Something are given 100% ASF factor, which is your tier 1 and tier 2 capital, your long-term debt, right? That is your 100%. 95% ASF is stable retail deposits. 90% ASF is less stable retail deposit, 50% ASF is generally wholesale funding, and 0% ASF is your all other liability and equity category. So ASF is like haircuts in reverse. The stable funding get your higher weight. And then we have something called RSF also, right? RSF is required stable funding. Okay, RSF required stable funding, which reflects the permanence of the funding required. Higher RSF means that assets that are harder to liquidate or take longer to run off, right? So again, 0% RSF is your cash, right? 5% RSF is your short-term security, 15% RSF is A plus to triple B corporate bond, 50% RSF is loans to financial institution, your 85%, 65% is residential mortgages, 85% is loan to retail businesses, 100% is all other asset, right? So illiquid assets require stable funding. Okay, so please understand this. NSFR is calculated by multiplying each funding source, retail deposit, repurchase agreement, capital by a factor reflecting stability, which has to be remembered from this table. ASF in the numerator and RSF in the denominator, right? So that we have to see, right? So funding, multiplying each funding source, right, by a factor which is ASF divided by RSF, right? So LCR we are calculating to look at survival for 30 days. NSFR we are looking for surviving 1 year. Leverage ratio is a safety backstop. Basel 2 had no such kind of rules. There was zero liquidity rules. Basel 3 fills that gap, and that's why we have it. Okay. So moving on, next one is a practice question. Now, if you look at the practice question, Highlands Bank has estimated stable funding in the bank to be 100 million. The bank estimates that the net cash outflows over the coming 30 days will be 137 million. Fine. The bank has capital of 5 million and a total exposure of 140 million. The bank estimates that it has high quality liquid asset of 125 million. What is the bank? LCR. Okay. So we have to calculate your LCR. Please understand what is LCR, right? If you look at the formula, LCR is what? HQLA, high quality liquid asset, divided by your net cash outflows, right? So HQLA is what? HQLA in this case, if you look at HQLA is given 125 million, right? Now, what is the net 30-day outflows? Is 137 million, right? So if you do it, so LCR is very simple, 91.2%, right? It is not harder at all, right? HQLA is given 125, cash outflow, right? Rest is capital of 5 million, total exposure 140 million. There are no use in calculation of your LCR, right? Bank cannot meet the 100% LCR. This means it cannot survive a 30-day stress scenario without outside funding, which is very risky for a bank. Okay, so but the calculation is very easy here, very straightforward, very easy, not at all difficult. Please understand. LCR is computed as following: we have 125, 137. We calculate 91.2. In the Highland Bank does not meet the minimum 100% requirement, as in violation of the rule. Okay, so Basel 3 requires a minimum liquidity coverage ratio of 100%. The LCR focuses on the bank's ability to weather a 30-day period of reduced disrupted liquidity. Okay, fine. All right. Now we are getting into another part, which is your contingent convertible bonds, right? Contingent convertible bond. Next part, let's try to understand that and solve it. Okay, not very long, but yes. So module 3 is about contingent convertible bonds. We have heard about it. Contingent convertible bond, basically these are those bonds which can be converted in equity during the stress period. It happened in Credit Suisse case in 2022-23, right? It's a very tricky kind of bonds. A lot of court cases also happened because of this. So but it is good for investors. It's good for not investors, good for banks to save themselves, right? And that is what it was done. And reforms which happened after the global financial crisis, which we need to understand. Okay, so let's get started. Let's try to dig deeper here. Now, when you look at the contingent convertible bonds, please understand COCOs act like your debt in your normal times and automatically turn into equity in your stress, providing your loss absorbing capital, right? So it's a good thing that they convert into equity in stress because banks want to save themselves. Right now, if you want to break it down comprehensively, please understand what is the difference between traditional convertible bonds versus COCOs. Traditional convertible converts only if the investor chooses when stock price rises. COCOs convert automatically when certain risk triggers are hit, typically during your financial stress. Now, why do you know banks use COCOs, right? What is the reason for banks to use COCOs? We need to understand that banks use COCOs because they behave like debt in good times, do not dilute shareholders, do not reduce your ROE, return on equity. They behave like equity in bad time, absorb your losses, prevent your insolvency. They allow banks to raise capital privately instead of relying on your taxpayer bailouts. This is why many European banks issued COCOs after the crisis. Okay, when do COCOs convert? Like, what is the logic here? There are three types. One is your tier one capital ratio trigger. Second is your supervisory judgment. Third is your market capitalization road trigger, ratio trigger. Tier one capital ratio trigger means if tier one capital falls below a certain threshold, there is an automatic conversion. Example was, Credit Suisse 2011 COCO issuance. There is supervisory judgment trigger. Regulator can force conversion if a bank is near failure, protects your depositors and taxpayer. This happened again in Credit Suisse in 2022-23. Then there was a market capitalization trigger based on market cap to roll asset, tries to protect your market distress early through your market capitalization is possible. So the purpose of trigger is to turn debt into equity before the failure happens. Okay, very interesting, very controversial. Okay, fine. Next one is a question we need to understand, right? So in this question, we just focus on which of the following statements is correct regarding the mechanics and motivations of contingent convertible bond COCOs. Please understand, when you look at the statements, the statement one is during your normal financial periods, COCOs are debt and do not drag down return on equity. Perfect. Correct statement, which I told in my notes also right now. During periods of financial risk, COCOs convert into equity, provides a cushion against loss, which helps prevent insolvency. Perfect. Both are right. Both statements one and two are correct. Right. So answer is C. Okay. So normal times, COCOs behave like debt. ROE is not diluted. In stress periods, COCOs convert to equity to absorb your losses and prevent your insolvency. Right. So this is what we have to understand. Very simple, very straightforward, guys. Nothing, no difficulty here, right? So unlike traditional convertible bonds, experiencing financial strain, same thing which I told you. Next one is reforms after the global financial crisis. When I say reforms after the global financial crisis, please understand there was Dodd-Frank Act, and there were some global reforms we need to just understand, right? Basel 3 fixed your bank capital and liquidity. Dodd-Frank fixed your market structure, consumer protection, derivatives, and governance, right? So I'm just putting it in a simplified way. Basel 3 fixed your bank capital and liquidity. Dodd-Frank, right, fixed your market structure, consumer protection, derivatives, and governance. Okay, fine. So moving ahead, the first point is we need to understand about Financial Stability Oversight Council, FSOC. Basically, you monitor systematic risk across the entire financial system. Financial Stability Oversight Council identifies your SIFIs, systematically important financial institutions. There's a SIFI requirement. SIFIs must prepare living wills. Living wills means plans for safe wind down, may face extra capital requirements and more oversight. Then there is an executive compensation reform, reduce your short-term incentive pay that encourages excessive risk taking. Shareholders get advisory votes on compensation. There are independent directors required for compensation committee. Then there was OTC derivative regulation. There is move towards your standardized derivatives to exchange or CCPs. Use your swap execution facilities, SEFs, for your transparencies. Goal was to reduce your counterparty risk and the opacity that worsened the crisis. Then there was a rating agency oversight, more transparency in rating models. Office of your credit ratings were created. Rating agencies face higher legal liability. This corrects the failure of rating agency during the crisis, your AAA CDOs. Then your consumer protection. Consumer protection means your CFPB created under the Federal Reserve. There is a clear loan terms and protection against your abusive lending practices. This addresses the subprime mortgage problem. Then there was a mortgage standard. Banks must verify your borrower ability to repay. If not, they may face restrictions and potential penalties. Purpose was to prevent another subprime style collapse. Then there was a risk management governance, means at least one board members in large bank must have risk management experience, and then your oversight at the board level. And then there was a securitization standard. Issuers must retain 5% skin in the game, reduces your incentives to create your low quality, high risk securitized products. And then there was a Walker rule, bans your proprietary trading by deposit taking institution, allows only client related trading. Delineation is challenging, but the goal is to eliminate bank speculation with insured deposit. So overall, please understand that Basel 3 was all about your capital plus liquidity plus buffers. Dodd-Frank is different. Dodd-Frank is about your market structure, your governance, your consumer protection, your derivative reform, right? So Basel was fixing the bank. Dodd-Frank was fixing the system, right? So Dodd-Frank fixed the system. Again, I give these hacks just to remember, right? Nothing else. Okay, so keep that in mind very, very clearly. So this was our last slide. Okay. Again, very detailed topic, right? Very detailed topic. There are small, small things which you need to understand here. If you understand, then only you'll be able to answer questions in exam, guys. Okay, fine. All right. Anything else we have to cover? I don't think so, right? We have covered everything here. I can do a quick recap of the chapter just for ease of understanding and just joining the dots. So if we go back to the starting of the chapter, I'll not write down anything, but just to join the dots, we go back from the starting. Just quick recap, guys. 5 minutes recap, then we kind of stop. Right. So please understand, we are trying to do the operational risk, and operational risk we are focusing on solvency, liquidity, and other regulation after the global financial crisis. Right. So what happened before the financial crisis we have already covered. Now we are focusing on after the global financial crisis. We are focusing on stress war, incremental risk charge, and comprehensive risk charge. and Basel III capital requirement, buffer, liquidity risk, and contingent convertible bonds, and Dodd-Frank reform. Okay, now when we go here, there are stress war, there is stress war calculation, incremental risk charge, comprehensive risk charge. We studied about each of them, right? We understood their calculation, we understood their horizons, confidence level. Then we saw what happened in IRC. IRC, we saw that what additional thing was added, which was 99.9% war calculation was added. And then we saw your comprehensive risk charge, how it was different for securitization, resecuritization, and then we moved to your Basel 3. Basel 3, we saw how we had tier 1 capital, tier 2 capital, and what were the total capital requirement, then capital conservation buffer, GSIP, CCB requirements, your counter-cyclical buffer, liquidity risk management, LCR, NSFR calculation, right? Your HQLA, net cash outflows, your ASF, your RSF, both are opposite. ASF is basically higher factor, means more illiquid. RSF reflects the permanence of the funding required. Then you have different categories, different factors we have to remember. Okay, and then there was a practice question we did. And then we moved to contingent convertible bonds and Dodd-Frank reform. Then what exactly happened in contingent convertible bond? What's the condition, the potential triggers that activate the conversion that we have to understand? And the practice question we did. And then we moved to the Dodd-Frank Act, where we studied that Basel III was fixing the bank's capital and liquidity. Dodd-Frank was fixing the market structure, consumer protection, derivative, and governance. And Dodd-Frank was basically fixing the system. Okay, so very theoretical in nature, guys. Very, very theoretical in nature. Go back, try to revise it. Not difficult, to be fair, but a lot to remember, right? A lot to remember. Focus on that. Please have a clear understanding. Note down small points, right? What will happen in this is that they will ask you a certain small point from the chapter. If you're not able to answer that, uh, you'll not get the right answer of the question in the exam, right? So you have to remember the small part, right? How the what is the calculation of ASF, what is the calculation of RSF, what are the ratios, how the if the CCB is added, CCB is mandatory, CCYB is at the country's regulator discretion. Then you understand that how tier 1 is changing, how total tier 1 is changing, what is additional tier 1, what comes in additional tier 1, what comes in total tier, what comes in tier 1, what comes in tier 2, right? What happens in GSIBs, CCB requirement, and what happens to the total capital, right? And then what happens in IRC? Why we use 99.9%? How see what is CRC, right? And what is stress war? Why do we need to have normal war, stress war, both calculation in your when you're trying to calculate the total capital charge, right? So this is detailed, right? And you need to understand the difference between Basel 2.5 and Basel 3. Basel 2.5 is different. Basel 2.5 was the immediate fix. You only added stress war, IRC, CRC. That was the initial action, right? And Basel 3 went for the bigger overhaul, right? They said that, okay, fine. Now we want to bigger overhaul, tighten the definitions, right? Definitions were tightened. That's why we have tier 1, very tight definition now, tier 2, very tight definition, elimination of tier 3, total tier 1 capital, what is it? Then we added the buffers on that, CCB, CCYB, GSIB buffer. And then we had the liquidity, right? NSFR, LCR. NSFR is for 1 year, right? LCR is for 30 days. Calculation is very different. How do you calculate HQLA, high quality liquid assets? What is ASF? What is RSF? Right? And then finally, we move to your COCOs and then your reforms after the global financial crisis, where we look at, okay, what is the difference between Basel III and Dodd-Frank Act? What exactly happened in Dodd-Frank Act? What are the fine, there are so many points in Dodd-Frank Act, right? CFI requirement, your executive compensation, your OTC derivatives, your rating agency oversight, your consumer protection, your mortgage standard, your risk management governance, your securitization, your Walker rule, right? There's so many requirements, right? You have to remember all these, right? So, but again, I have given you a hack that please understand when you're fixing the system, that is Dodd-Frank. When you're fixing the bank capital and liquidity, that is your Basel III. Okay, so have that very clear understanding. If you have that, I think you will be fine. But this is not a chapter which has to be read superficially, right? This is a chapter where you have to go, even though the logics and the understanding and there's no numerical here, not much numerical, and logic and understanding is pretty easy, but there's a lot to remember, right? There's a lot to remember and a lot of small ratios and percentages and 4.5% tier 1 and 6%, 8%, right? The ratios are there, percentages are there, 2.5%, right? GSAVE 1 to 3.5%, HSBC, JP Morgan 2.5%, countercyclical buffer is different, right? So you need to know those numbers, right? And you need to know that, okay, fine, CCB is 10.5% in the normal time, then it declines, right, in the stress time, right? So all small things, that is what comes in exam, right? And also downgrade, right? A downgrade of capital. There was a question which we did that the deficit in the pension plan, then you downgrade the capital, right? There are 2, 3 things where you downgrade, right? We have done a question in between. Just go back and look at it, right? Very interesting topic, very long, very lengthy, and a lot of small points, right? So pay attention, go back and revise it. That is what the aim here. And I'll see you in the next lecture. Okay. All right, guys. Thank you.